You enter the office before the day has fully taken shape. The room is quiet, but not relaxed. Desks are clean. Screens are already awake. Messages move across them without drama. Yet nothing here is casual. Every number belongs to a decision. Every decision belongs to someone who has been allowed to touch capital. From the outside, a hedge fund can look like a place where intelligent people try to predict markets. But prediction is only the visible layer. Inside, it is a permission system. At the bottom, you are allowed to see information. Then you are allowed to organize it, interpret it, defend a judgment, place capital behind it, scale risk around it, build systems that repeat it, and finally, own the structure that holds it all together. The real hierarchy is not title, it is permission. And the first permission is simply to observe. Level 1, the observer. At the first level, you are close to information, but not close to control. Reports move through the firm before you fully understand why they matter. Dashboards update, prices shift. Meetings happen in short, compressed language. People talk about exposure, liquidity, downside, catalysts, and risk, as if every word has already been filtered through money. So you listen. You learn the vocabulary before you are trusted with the meaning. This is where the first illusion breaks. Being near the machine does not mean you can move it. You can sit inside the system and still remain outside its power. You can see information, but you cannot yet shape what it means. Proximity is not power. If you want the next permission, the test is simple and unforgiving. Can information pass through you without becoming less reliable? Level 2, the organizer. At the second level, you are trusted with order. You take scattered information and make it usable. A table that can be understood quickly. A model that does not break when an assumption changes. A memo that removes confusion instead of adding more of it. Other people use your work to think, but they still own the conclusion. This is where accuracy becomes your first currency. Not confidence, not creativity, accuracy. A small error can travel upward and become a larger doubt. A wrong number, an outdated source, a broken formula, a weak assumption. Each one tells the system you are not ready for judgment. So you learn discipline before influence. You learn that trust is often built through work no one applauds. The best version of your output is almost invisible. It simply works. Now, you no longer only know where the information is, you are ready to ask what it means. Level 3, the interpreter. At the third level, information begins to change shape. Revenue is no longer just a line on a statement. It becomes a signal of demand, habit, pricing power, or temporary excitement. Margin is no longer just efficiency. It shows who has leverage, who is under pressure, and who can pass costs to someone else. Debt becomes a timer. Cash flow becomes oxygen. Customer behavior becomes evidence. Management language becomes something you listen to not only for what is said, but for what is avoided. You begin to read a company as a system. Money enters through customers, moves through costs, contracts, incentives, competition, and expectations. Somewhere inside that movement is the truth the market may be missing. This is the first real act of judgment. But judgment without authority is still fragile. You can understand something before anyone believes you. You can see the pattern and still have no permission to move capital toward it. Information only becomes valuable when it becomes judgment. And judgment only matters when it can survive being questioned. Level 4, the conviction builder. At the fourth level, you learn that knowing more is not enough. You have to make the idea clear enough for someone else to risk money on it. Weeks of reading, modeling, calls, and quiet doubt must become a thesis, not a pile of evidence, not a long explanation. A thesis. What do you believe? Why is the market wrong? What changes the price? What is the upside? What is the downside? What would prove you wrong? Complexity no longer protects you. If your idea needs too much fog around it, the system begins to suspect you do not fully understand it yourself. The strongest people in the room are not always the ones with the most information. They are the ones who can isolate the one thing that matters. So you learn to speak with conviction. Clear, calm, specific, unemotional, strong, but not defensive. At this level, you are not yet controlling capital, but you are beginning to influence the people who can. And when conviction becomes strong enough, it stops living only in your mind. It begins to pull capital toward it. Level 5, the capital allocator. At the fifth level, judgment becomes capital. Until now, your thinking could be discussed, challenged, revised, or rejected. It could be sharp, but still harmless. Now, the system allows your judgment to become exposure. You are not only deciding what you believe, you are deciding how much the belief deserves. That is the part most outsiders miss. A good idea is not enough. A good idea with the wrong size can still damage the portfolio. Too small, and the insight barely matters. Too large, and even a correct thesis can become dangerous if timing, liquidity, or volatility turns against you. Capital does not reward opinions. It rewards sized judgment. Every decision leaves a record. When you entered, how much you allocated, where you cut risk, where you stayed too long, where you were early, where you were right but not right enough to survive the path. A loss is no longer something you feel alone. It becomes a drawdown, a meeting, a review of your process. A quiet question about whether the trust placed in you was too large. This is the hidden cost of being allowed to move money. You do not just create return, you create consequences. And if you survive long enough, the system stops asking only whether you can make money. It asks whether you can protect the right to keep playing. Level 6, the risk scaler. At the sixth level, the capital grows, but the room around you gets smaller. You have more authority now, more resources, more attention, but less freedom to be impulsive, less permission to be vague, and less space to explain mistakes as learning. The focus changes. It is no longer about one strong idea. It is about consistency, drawdown control, exposure, liquidity, concentration, internal trust. You begin to understand that the fund is not only watching your upside, it is watching what happens when the market turns against you. A good year does not prove skill. It may only prove that the weak part of your system has not been tested yet. So you learn to respect survival. Reducing risk before panic is not weakness. Cutting size can be intelligence. Staying alive through a bad cycle can matter more than looking brilliant in a good one. At this level, consistency becomes more valuable than brilliance. The more capital you control, the more you are measured by your ability not to damage the machine. But risk has now become too large for one mind alone. To move higher, you need more than judgment. You need a system around it. Level 7, the system architect. At the seventh level, you stop being measured only by your own ideas. Now, you are responsible for the system that produces ideas, tests them, challenges them, and removes the weak ones before they become expensive. You are not just asking what the fund should believe, you are designing how belief is formed. This changes the work completely. You hire for judgment, not polish. You look for people who can find what consensus has stopped noticing. A good analyst can build a model. A stronger one can see where the model is hiding a false assumption. You shape the room where ideas are debated. You need disagreement, but not ego. You need pressure, but not politics. The machine must be uncomfortable enough to expose weak thinking, but stable enough that people still tell the truth. At this level, Edge cannot depend on one brilliant person. It has to become repeatable. But research is only half the architecture. You also begin to see the fund as one system of exposure, correlation, leverage, liquidity, counterparty risk, crowded trades, macro shocks hiding under different names. The most dangerous risk is not always the one everyone is watching. It is the concentration formed quietly by many decisions that looked independent. Your job is to see the whole before the parts realize they are connected. And if you do it well, the disaster you prevented may never be visible. But even the best system has one final requirement. Capital outside the firm still has to believe in it. Level 8. The structure owner. At the 8th level, you are no longer managing a position, a book, or even a system. You own the structure. People, process, fees, reputation, legal design, investor relationships, culture, succession risk. The parts of the fund that most outsiders never see, but every insider depends on. You decide who gets hired, who receives capital, who is protected during pressure, and who is removed when trust breaks. You decide what kind of risk the firm will accept, what kind of capital it will refuse, and what story investors are allowed to believe about the machine. At this level, you are not only speaking to markets, you are speaking to institutions, pension funds, endowments, foundations, family offices, sovereign-scale allocators. They are not buying excitement. They are buying something they can explain. They want to know how drawdowns are controlled, whether the process survives if one person leaves, whether liquidity holds under stress, whether the allocation can be defended in a committee room by someone who may not understand the trade but understands responsibility. This is real ownership. But ownership is not escape. Your reputation becomes an asset, then a constraint. Your name becomes attached to the system's discipline, its culture, its mistakes, and its survival. You own the machine other people climb. And if that machine loses trust, you do not simply lose capital. You lose the role the structure created for you. The hedge fund begins as a place that appears to reward intelligence. But level by level, it reveals a colder structure. First, you are allowed to observe, then to organize information, then to interpret it, then to build conviction strong enough for others to trust. Later, you attach capital to judgment, scale risk, design the system, and finally own the structure that others depend on. But the person at the top is not simply the freest person in the room. They carry the deepest attachment. Capital watches them. Investors measure them. Regulation surrounds them. Reputation follows them. The story they built becomes something they must continue protecting. In the end, the hedge fund is not just a ladder of wealth. It is a hierarchy of permission. Money does not end the game. Structure changes your role inside it.